Sharif has another commitment that he has to leave for at 10:30. I've got another commitment that I have to make at 11 o'clock. So some of the things I thought we would cover today, we may have to postpone until at the next meeting, which are urgent.
Okay.
All righty, let's have a roll call, please.
Here.
Happy Finn,
Present.
Paul Hample,
Here.
Sharif Mansuri,
Here.
Captain Aaron Schaefer,
Here.
Milton Wilkins,
I am here, body and soul.
Levon Singleton, Matt Levacy.
All right. First thing on the agenda is approval of board member absence. We have none today. We have an empty chair, which if you read my email, is not likely to be filled in this calendar year. Recall my email.
Yes.
It's self-destructive.
Uh-huh.
We are one of the few agencies in county government that actually makes money for the county. You would think we would be fully staffed to do that, but that's not going to happen. It's a political matter. It's not a business matter or a board matter. Nevertheless, we press on. Approval of the minutes of the March 24th meeting.
So moved, Sample.
Second, Wilkins. All in favor?
Aye.
Aye. Fine, good. Okay, request for benefits. First, we have the civilian retirement. Gosh, I had-
Move for approval, Hample.
Second.
All those in favor of, first of all, Rachel, is there anything in the civilian retirement benefits that's controversial that we ought to know?
No.
Okay, all those in favor then?
Aye.
Any opposed? All right, the request for police benefits, retirement benefits.
Make a motion to approve. Second, Hample. Pepe, Seth.
Anything controversial? Somebody actually didn't pass away or something. All righty, very good. All those in favor?
Aye.
Carried. Request for police death benefits.
Make a motion to approve. Second.
The civilian requests,
You said police.
please. I'm sorry, should have said, well, what doesn't matter. Let's take police requests. You have a second. All those in favor?
Aye.
And civilian requests for death.
So
benefits?
moved.
Second.
Scott and Pepe. Done. So far, so good.
All in favor? Civilian?
Well, we just hit,
With the cops.
we did counts first, then we did
Right.
civilian.
We have this,
We had
I
we have
thought
to
we
vote
did
on the
civilian.
civilian.
I thought we actually voted on it. All right, fine. All those in favor of the civilian requests as noted?
Aye.
Any opposed? That's what happens when you do things out of order. You lose track of everything. All right, we're turning it over to the ACG at this particular point.
Okay, thank you. Good morning, everyone.
Morning.
So this morning I'll go through the,
Excuse me, Aaron?
I get up.
oh, does anybody else need one?
Thank you. So
I'm gonna walk through the March performance report, just some comments on capital markets. And then we brought back some information at your request related to real assets and currency exposure. So first thing I'll say is we look at the March report, things have changed quite a bit since that time. With the onset of war in Iran, we did see markets sell off quite a bit. So when we're looking at these March numbers across most asset classes, year-to-date numbers through the end of March were negative. That's changed quite a bit. Equity markets have been pretty resilient over the last month. And so now year-to-date, if we go to in tab 1, page 5, on the left-hand side of the page, you'll see broad index returns through the dark blue bar is the month of March, and the light blue bar is the year to date, so the first quarter of the year. And you'll see the only positive through the first quarter of the year was small cap stocks, the Russell 2000 up barely, just under 1%, 0.9%. Just by way of updating where we are today, I think I saw this morning that The month of April is on track to be the best month for the S&P 500 since June of 2022. So it's been a pretty significant rebound. Year to date now through yesterday, the S&P is up a little over 6.25%. Small cap is up a little over 12.5%. International stocks are up about 6%, and EM emerging markets year to date are up 15%. So at the end of last month, emerging markets were slightly negative. Go forward 23 days and we're up 15%. Trailing 1 year numbers are very strong. As we look at trailing 1 year numbers now, you're taking off the period where tariffs were announced, and we saw markets fall at the beginning of last year, but then rebound quite a bit. So just from perspective, and I think this ties into overall fund performance. Trailing 1 year numbers now through yesterday for the S&P are positive 36%. Small cap and international outperforming U.S. large cap. It's been a while since we've seen that. Small cap through yesterday on a trailing 1 year basis is up just under 50%. International up about 36.5%, and emerging markets are up 52%.
That's from the trough.
From the trough last year, including the month of March. That's not to say that, the volatility isn't going to continue. We're seeing quite a bit of volatility with respect to geopolitical events. I think it's important as stewards of long-term capital to remember you're investing these assets to cover liabilities many, many years into the future. You're investing to pay benefits for new employees that are in their 20s that you're not going to be paying for 30 to 40 years. So we know that there's going to be volatility in the short term. Over the long term, generally, we see stocks outperform. The biggest message with respect to portfolio results, what you'll see is absolute returns. So the absolute level of returns at the total portfolio and really at the underlying manager level are very strong. Above your target rate of return, and generally at each asset class above what our expected return would have been if we went back 10 years ago, or even what we're projecting going 10 years forward. The absolute level of returns is higher. Relative returns is a different story, and we'll talk a little bit more about this. And I think we've touched on this. It's been relative returns for active managers has been very challenging over particularly last year. And in 2025, within small cap, and I know we've talked about the small cap portfolio and you've made some adjustments there, about 20% of active managers outperformed the benchmark in 2025. So 75% underperformed. The median manager was about 4.5%, meaning that if you're in the top half, just under the top half, you still underperformed by about 4.5% the benchmark.
Excuse me, Jason, I missed it. Which asset class are you
Small
talking
cap.
about?
Small cap specifically. The biggest challenge there has been non-earners and low earners. Companies that had either negative earnings or no earnings were the best performing companies by far within the index. Most active managers, and I see some odd looks like, how can that be? Oh, there are a lot of speculative names tied to AI, some biotech names that just maybe a drug was approved and returns shot up for that particular security. Typically, we're not seeing active managers owning those names to that degree. Over time, we look at historically over time, that's generally not sustainable. Generally, in periods following significant low quality rallies like that, we do see active managers bounce back pretty significantly. The other area that was probably the most challenged from a relative return standpoint is on the international side, specifically growth-oriented managers. Outside of the U.S., value actually did better than growth. The non-U.S. indices are more heavily tilted to values and financials. Your non-U.S. equity two non-US equity growth managers, WCM and William Blair on the small cap side. We're not immune to this. Really struggled on a relative basis. 10% of, well, I said 20% of small cap managers outperform the benchmark. 10% of non-US growth managers outperformed the benchmark last year. That's how challenging it was. The value side, Silchester actually did a nice job of balancing that out. Silchester was up 23.25% last year, and the benchmark EAFE was up 21%. So just looking at on page 7 at the total return, total portfolio level, as I mentioned, absolute return strong for the portfolio, up just under 13% on a trailing 1-year basis through March. We'd expect that to go up. It's going to look even better after this month, assuming the next 7 days we at least hang in there. Trailing that strategic policy benchmark by 2.5%. That's that active management dispersion. A lot of that coming on the small cap and the non-US side. 10-year number, the 10-year return for the total portfolio net of fees is up over 8%. So that's trending well above the target return of, I think you're at 7.25%.
It's been as high as 7.5, but it's in that narrow range of 2.25 to 0.5.
And I'd say relative to what our projections were 10 years ago, that's above that, and that's above where our projections are today. So the point is, we've come through a really strong period. As I mentioned, some individual dispersions of some active managers. From an asset allocation basis, we're pretty close to target. You have made some adjustments over the last couple of years to your strategic allocation. One, bringing real estate down. The real estate allocation is almost right on that 10% target. That's happened in a couple of different ways. One, through some redemptions. The other, just because equity and fixed income has done a little bit better than real estate over the last year. You still have about 7 million in outstanding redemptions from Reef and Heitman. That's been coming back a little bit at a time. I think we expect to get about 1.6 million. It's targeted for today or tomorrow to come back from Heitman from a redemption standpoint. So your target to real assets is really going to be right on top of that 10%. Within equities, we're right at the target. We're really right at the target in equities and fixed income if we include the cash. Underlying within equities, your target allocation today, and Craig will talk a little bit more about this. We're targeted to be about 50-50 US and non-US. The actual allocation is slightly deviating from that. We're a little bit underweight to international developed, but we are overweight to emerging markets, and Acadian is your sole emerging market manager. That's actually been a positive because emerging markets has been the best performing asset class. Acadian on a 1-year basis is up 27.3%. Your international developed managers are up 23 and 12.5%. So being a little bit overweight. Part of that is that Acadian overweight is earmarked to go into the BlackRock International Value Index strategy. And it's just a function of one that gets up and running through the internal processes.
I thought that was approved. It's not approved.
It's been approved by this group and navigating its way through the internal channels.
At your end.
No, we don't have any authority to.
Oh, so
execute
it's
it.
still, I thought we got an email saying it's done.
It's been approved, finally. Finally, it's been approved by the county council. It hasn't yet been implemented.
What does implementation look like and what does it need? At their end.
Rachel and I discussed it, and we're going to get with Marcy.
Yeah.
And see what's.
It's execution of agreements.
The agreements are not yet signed, is that what you're saying?
Correct.
Okay, why are they not yet signed?
They're running through the channels, and
So it had, in this particular case, it had to be approved by the county council before you would
correct.
And in the past, it all went through legal review before it went to the county council, the past years.
Okay, that, I'm not sure about.
Yeah,
Is this something that like somebody can call and push through? I mean, 6 months, 8 months in is like, we can't do anything here.
Right.
It's a joke. If 8
It was
months, you
just
can't even,
approved by the council. I mean, that,
no, but is that something you or somebody else can call and say, hey, where are we with this? Or is that something that
Are
can
you
be,
talking about the county council now?
yeah, just push
That
this thing
that was the
along.
reason for my meeting with, got my email. There was a reason for my meeting with Hayes to move that along. And then we began to talk about other things as well. But it should not have taken that long to begin with. It's a simple matter. As I explained to her, it's routine on our part. But apparently the county council, or at least the chair of the county council, is not moving as rapidly as they should.
So they didn't agree when you met with them that this needs to be moved along and done,
They approved it right after that, my meeting with them.
but then it hasn't happened.
It hasn't happened. Because now from the county council it goes back to the general counsel's office. And the general counsel has to conclude your discussions
right,
with the parties involved in terms of the legal agreement. Rather than the legal agreement being approved first.
So can an email or some follow-up be done to say, hey,
It's now in the county council's
right.
office.
Rachel and I will get together with ACG and hopefully have an update by next meeting.
update?
Can it be,
How about an execution?
can it,
We'll see.
well, I guess we have to approve the actual contract.
Right.
Is there anything in the contract that represents a problem?
Not that I'm aware of right now.
How, if the contract were approved tomorrow,
Mhm.
how quickly could we actually implement?
It depends on what the contract says. I don't have that information right now.
You know, in normal corporate conditions, when a decision is taken and it's not executed, you could be sued for the market movement on that money in that time. I mean, I don't see how the city sits on something for 6 to 8 months and not execute something which could have a potential loss to the plan.
Okay.
And in this case, it does. Just saying.
Well, let me say this. I can't imagine there's anything in the contract that would be objectionable. After all, these are not separate contracts, commingled trusts. It's not going to change a whole lot in any event. So if you can get that together, we can have a special meeting of the board, telephonic. The board will officially then approve the contract, and then we can implement it hopefully by mid-May, because I would imagine they would want to be notified or whatever by mid-May of inflows as well as outflows. That is what I would think would happen. Does that sound? Can we do that?
We can work towards that. Yeah.
So is this a contract with BlackRock?
Yes.
Okay,
Which is a,
BlackRock, I don't think is probably real negotiable.
No, there's not a lot to.
I mean, I don't think there's a lot that we're gonna be able to
that's
say.
what I've said, they're commingled trusts, they're not gonna.
Right, they're the
This is-
800-pound gorilla. You
Well-
sign it or you don't.
While this is not. It is taking a bit of time, but this has not been unusual according to how this plan and the internal operations have gone historically. There's several steps that have had to be taken and several people that have to sign off.
Again, if you can check the subscription,
That's why-
the dates, the deadlines for commitments and deadlines for withdrawals. We work back from there and try to get this thing finally implemented since it's now been approved. And I would imagine our phone call would take about 5 minutes. Right? Okay, continue.
That's all I had on the monthly report, unless there's any questions, and turn it over to Craig.
I haven't had
Okay. All right.
much of this has been at least somewhat reversed by what's occurred in April. All righty?
In all the best ways possible. As the market
Yes.
bounced back. So I was here, we didn't have a meeting last month, but I was here 2 months ago. And we're talking about dollar debasement and real assets and bringing forth strategies. So we're following through on that today. We've offered some, however, before we get into that, first wanted to walk through why real assets. And then how you have that, how it's currently been implemented in the portfolio and show you what's already existing in the portfolio to protect from some of this dollar debasement or the conversation that you all had around that last time. Under tab 2, page 13, this is just a snapshot of why real assets in our view. So it's a diversifying asset class that is intended to provide an inflation hedge. It sits in between equities and fixed income. And you have exposure to that today. As Jake mentioned a little earlier, you have a target of 10%. That used to be 15. It went down to 10. So you have real assets exposure in the form of real estate in the program today. There are other ways to skin a cat for real assets, which is on the next page. These are the major food groups of what we're talking about when you're looking at diversifying ways to kind of employ a real assets strategy. One is real estate, which you have direct exposure to through 2 managers. Infrastructure, farmland, energy, precious metals, gold, silver, copper, things like that. And then we have in here what each of those are and what their inflation attributes are. But quite simply, instead of all of those words, just think of inflation always goes through a cycle. Early cycle, late cycle, mid cycle. All of these things are meant to attack inflation at usually see from a commodity perspective. That's where you usually see inflation first. That's early cycle, right? If commodity spikes up, that's early cycle inflation. Late cycle inflation and stocks are also another way. Think of the simple example is Walmart, right? If cost of goods go up, what are they going to do? They're going to make you pay more for it, right? So that's an inflationary. So stocks tend to be a very good inflationary hedge, long run. So the idea is you have all of these different buckets for different levels of different cycles of inflation. So I hate to jump pages, but let me do that. On page 27, it's under tab 3. So what do you have in the portfolio today? What exposures do you have today? This is the pie chart on page 27. What do you have in the portfolio today in this kind of real assets, inflationary hedge, dollar debasement potential bucket? This is a simple pie chart of what you have in domestic equity in light blue, international equity in dark blue, fixed income, and then that real assets in that orange or that yellow. So starting in the upper right-hand corner, your U.S. equity portfolio is not just equities. It also has REITs in there, real estate investment trusts, which trade as stocks with their income producing units that are tied to inflation. Also, metals and mining companies, right? So going back to real assets, these are the folks that take it out of the ground. That dark blue box, which represents 31% of the portfolio, has metals and mining companies in there, has infrastructure companies in there, as well as just the fact that the currency fluctuations, which has been a problem for this area of the market up until recently. So you get a tailwind, a benefit if the dollar weakens, that 30% of the portfolio strengthens and vice versa. So there's multiple layers of this type of conversation.
Ties back to when we said that the non-US and the emerging markets have outperformed US over the last year. You're getting a benefit of that tailwind of the dollar declining recently, where really the better part of the last decade, that was a headwind.
And we have a slide in here as an example of just mechanically how this works and why international equity exposure is a way to protect against the US dollar currency fluctuations, particularly a weakening dollar in the event of potential debasement. So that's at a very high level, but if you take it another step further, that colorful chart I just showed you a couple slides ago that showed infrastructure, REITs, tips, things like that. If you take that another step further, you say, what does the portfolio look like? How much does the portfolio today have in tips? Have in international fixed income, which is non-dollar based? How much does it have in real estate? How much does it have in materials, commodities, things like that? 9%. If you look on a look-through basis on your underlying portfolio, 9% is in these kind of real assets things. No, this is at the underlying level. Plus,
Yeah.
plus real estate, which is another almost 11%. So in total, about 20% of the portfolio could be categorized as real assets, inflationary hedge type portfolio. So I wanted to start there with this is what the portfolio looks like today, and you are exposed to those areas of the market. I'll pause there for any questions.
Sure, go ahead.
Okay. So now let's jump back to if we're operating under the idea that we have exposure to these things, is there anyone out there that just does this as a standalone? And put some in here. The next few pages go over the benefits of. I'm trying to get to the one that I wanted to describe. Let's go to page. Let's go to page 18. So I think what has grabbed a lot of headlines lately is gold. Gold specifically. Gold was up almost 90% last year, and it is
39%
flash.
trailing 1 year basis.
Yeah. But it was up about 90% last year. The point is of this page on page 18, it tends to be pretty long cycles that are informed by very sharp spikes. So you look at, gold is the best thing to own in the early teens. Didn't want to own it at all in the middle teens. And then as of last year, you really wanted to own it, gold, right? So it's a function of how do you acquire that? And your portfolio is through miners. It's through emerging markets. It's through kind of non-US exposure in total. So gold comes into and out of favor, but it does provide equity-like volatility, which you can see on page 19. This is a simple risk-return scatter plot. We've highlighted appropriately in gold. B is gold, and you can see that it has similar volatility to actually more volatility than, say, the S&P 500, which is K, to the right, with a comparable level of return. That's over the last 20 years. So more vol, same return. This has been a topic that a lot of clients are going through. Any questions around that? Okay. So again, 2 months ago, I was here and the question that was raised by the board was, who out there does this tactically? Are there any real assets managers out there? And we're illustrating 3 here. All 3 of them go about it a different way.
What page and are you on?
Page 21, the next page.
When we say tactically, we're talking about a real asset manager that is tactically allocating to real assets, not into real assets and then out of real assets and into stocks. This would still be assuming a strategic allocation where you're carving out a portion of your portfolio in addition to the 10.5% that's dedicated to real estate, and then the underlying exposure that you're getting, you'd be adding strategically to that exposure.
Right. So they're technically allocating to just a small bucket of the world, which is all of those food groups that I was talking about around real assets, but each go about it a different way. The first one here is PIMCO. Effectively, they allocate amongst, in the middle of the page there where it says sector diversification, their primary food groups are TIPS, Treasury Inflation Protected Securities, fixed income instruments, that's that 40%, commodities, and real estate. Again, these are all things that you already own in the portfolio today at some level. Your active managers that you currently have are going into and out of these things as they see fit. Principal diversified real assets in the middle. Again, sector diversification, a little more broad in their approach in terms of they incorporate infrastructure, REITs, commodities, natural resources. Again, all of the things that you already own today, but just their tool set is opened up a little bit more.
Going back to PIMCO, but also including principal, how do they invest in real estate?
How do they invest in REITs?
Just REITs.
REITs,
Okay, fine. Publicly traded.
publicly traded REITs.
These are liquid
Okay.
strategies.
And then
Liquid strategies.
These are liquid.
these are liquid strategies. Yes, these are all
I mean,
liquid
not-
strategies.
they don't pretend to be liquid until
No,
the prices become.
there's no
illiquid.
price.
These are actually traded on the exchange, right?
And you can see that in the volatility, Milt, in that the REITs are equities and they trade like equities. Commodities also trade like equities, which is the last one there, Van Eck. You can see oil and gas, precious metals, looks attractive, but when you get down to it and you look at the underlying things, their number one holding is ExxonMobil, Chevron, Shell. These are individual stocks. It's not, you're not owning gas, you're owning a stock representing gas, right?
Mhm.
So that also increases the volatility. So these are three kind of big players. You can see PIMCO, massive shop. This strategy, this product only has about $182 million in it, but you can see 2.4 billion. These are some of the leaders, if you will, in the area of this niche area of the market. I'll pause there and I'll show you some of the comparisons that we have for these things versus other areas of the market.
Before we do that, let's take a second to revisit what our original objectives are here. Or if we're going to do this kind of allocation, what are the objectives? One is inflation protection. Another is to invest more heavily, overweight areas where we think there are good returns in the future for any number of different reasons, right? What other objective would there be?
Those are reasons why I think where we're trying to go here is you already have them. And
Diversification would be another reason.
So that's fine, I'm
Right.
saying.
Yeah.
That's what I meant by other areas that offer good return.
yeah, I mean, ideally in periods of market distress, these would be uncorrelated, right? More direct exposure. So that's the diversification that,
And we believe, as I recall, Sharik is more articulate on this than I am, that given the current level of projected deficit in the United States, the value of the dollar will go down.
Mhm,
Inflation will stay stubbornly high,
mhm,
contrary to the Fed's objective of 2%.
mhm.
And therefore, if in fact that materializes, we want to have at least some vehicle or vehicles, plural, which can do reasonably well in that kind of environment, since that kind of environment appears to have a high probability. Did I say that right, Sharik? You're the statesman on this.
Okay, so let's take a step back. So to address some of the things, I mean, your grandfathers probably bought a house in this country for $10,000. Your parents probably bought it for $50,000, and you're probably buying the same house for $400,000 to $500,000. So has the real estate increased or has the currency depreciated, right? So your buying power, so as to say. So with that background or with that backdrop, as they correctly pointed out, stocks and all assets, real estates and real estate, etc., provides an inflationary hedge. That's absolutely correct. So while the value of your money is going down, we invest so as to keep up with inflation so that we can still buy that house. We make money on that thing. So very simply put, in a very crude sense, that's the backdrop. Okay. The issues we face right now is that the market is overvalued by most historical standards. What is the price to sales ratio right now?
Price to sales ratio?
Approximately.
The PE ratio, which is more of a function, 23, 24. Depending on what.
So price to sales ratio is probably just another valuation measure. We talked about the PE ratio, so I thought I'd change it up. But the price to sales ratio right now is 3.6. Okay. The average runs at 1.9 in the country.
The average
that is,
over what period of time?
sorry,
The average over what period of time?
last many decades, if you say. What that tells us is that the market is overvalued, and there are two outcomes here. I mean, we can keep printing money and it can go up further, and these ratios can get more stretched a little bit. But at some point, if we see normalization, either the equity market is flat for 10 years. Have we seen that before? We have in the 70s. So there are cases of where that may happen. This long-winded answer, getting to the point here, is that while some of the assets that we've talked about, equity and real estate, provide this inflation hedge, the question is, how well will they do that going forward, given the current valuations? Okay. Real estate has its own headwind with material costs rising, consumers may be getting weaker. We already seen a hit on the corporate side, right? So of course, one star area is warehousing and all that stuff. But without going into the minutia of the details, the objective, as Milt asked, what is the objective? And now we get to the objective, is to isolate, if we can, some asset classes that have not moved or have still moved and still provide a valuation in this environment. And the environment is, again, the backdrop. Your assets are, by traditional methods, overvalued, and dollar debasement is going to probably pick up because the debt in this country is 40 trillion. If we add on municipal and private debt, we are at 120 trillion. We can't pay that bill. All right, we can't pay that bill, period. If you can't pay the bill, what do? You print money. We're already doing that. So we're going to print more money. You don't have a choice in this matter, whoever is in the administration. When you print this money, the value of your dollar is going to go down. It may do it in spurts and bursts, and how it does it, it's like a camel sitting, who knows? It is not a uniform linear path, right? You have a war, the dollar gets a little strength, okay, on the war, but these are typical cycles, and if you take it over a long run, which is what we are here for, over the next 10 years, the dollar will debase. We are, I mean, and worse events can happen, in my opinion, because we can't pay this debt. And the worst events are war and related to that, whether we default, what we do. So in that kind of environment, holding things like real assets makes sense. Okay. And commodity cycles typically are long, they are not short, right? So in the three options you provided, going down that road, PIMCO would not be of interest. You don't really want tips and you don't want all this real estate. Something like VanEck, which is investing in gold and precious metals, oil and gas, base industrial metals, agriculture. So food is another thing that does probably good in the sense that, anyway, that's another discussion. Paper and forest, so that would be more along the line. However, what I don't understand is why only these three choices exist when one of the objectives was to keep the cost manageable. So my retirement plan, most of it, is in State Street Real Asset Fund.
Is this a public fund that you work with?
Yeah, State Street, you should be able to access it. State Street is big, right? I don't know what your platform allows you to access.
No, I mean, is this a public
I'm just
pension
giving-
plan that you're working with?
Yes,
Which,
which is Bank of America's public plan, which was Merrill Lynch's plan.
oh, okay.
It's not public. But anyway, I'm just want to give an example. Year-to-date return 13.41%, 1 year, 27.89% beats anything that you've given. But more critically, the cost you've given, 0.41% on PIMCO, 87 basis points on Principal's Diversified Real Asset Fund, and VENEC is running at 0.95. This State Street runs at 0.18. Huge difference. We're not talking about 20 bits. We're not talking about 15 bits. We're talking about almost 70 bits. I don't know why this has been such a struggle. If we had, I mean, I think I've been on the board for 2 years, and I suggested this about 2 years ago almost when I entered, saying these are my concerns. And we would have benefited had we allocated to this. There are struggles within the board, as we are realizing with BlackRock on our side, absolutely, that we can't move and we are like molasses. But why we've not been given options such as this is also kind of mind-boggling to me. I've been asking that you guys provide, because I don't want to provide. That's not what I feel comfortable with. You are the consultants. You should bring the investment choices that you're comfortable with and propose why. I should not be doing that. The only reason I brought this here is a little bit of frustration as to why you can't execute this on the side.
Number one, we don't execute anything.
By execute, I mean bring us the investment choices that have been asked for. What was asked of you more than a year ago was give us some choices that are allocation funds towards real assets and commodities. And again, this is the third list that's been provided of choices. And I think it's mediocre or substandard to this choice. And I don't know why. I really don't know the answer why, as to why that is.
Sharik, is that an ETF?
It's institutional fund. It's State Street Real Asset Non-Lending Series Fund, Class K. I can give you this.
So, couple of things. Number one, whether it's 17 basis points or 41 basis points, the point is we wouldn't recommend a dedicated allocation to this, and you already have this stuff, which is costless.
We
You already have exposure to all of this stuff.
So
Whether it's
I'm not-
17 or 95.
So I'm not comfortable with the real estate exposure that we have, and we can have that discussion. That's why we are lightening it. If we lighten up on real estate, as we are already doing, and that money comes in, we can start allocating to something like this, which is 2, 3, 4%. And number two, they are an allocator, which within that category, which also is VENEC, and VENEC is a good company. I would have no problem with VENEC Global Resources Fund. The only thing that catches my eye is the 0.95% cost.
Right, and let's focus on the cost thing for a second. You already have VENEC as an example. The reason why I started with the pie chart and what you already own is you already own those things. Let's not increase the cost for 17 basis points or anything else for a dedicated exposure to things that you already own. VanEck, as I said, it says oil and gas, it says gold and precious metals, but those are implemented via stocks, which are already in the portfolio.
So if I recall this correctly, the allocation is 10% real estate.
10% real estate.
In our portfolio.
But you have another 9%.
Correct. That is in this chart, the breakup. Or is this representing the whole 20%?
No, that 10%, the gold, that pie chart that Sharik is referring to on page 27, the gold slice of the pie is your dedicated exposure to real estate.
Strategic allocation, what you've determined in your
So is this the breakup of the 20% or the breakup of the remaining 9%?
breakup of the total portfolio.
No, it can't be. It doesn't add.
What, US equities,
doesn't add
international
up to that.
equities, fixed income and real estate. That's the total portfolio. What
Oh,
I'm,
sorry, I'm looking at the wrong chart. I was looking at within the breakup within this remaining 9%, right? So even if you go by this,
Sprinkled in, so what Craig was explaining, the 10.9%, that's dedicated allocation to real estate. And what we were explaining is that you also have exposure to real assets through your fixed income portfolio, your domestic fixed income portfolio in the form of tips and non-dollar bonds. You have within your non-US equity portfolio and your US equity portfolio. Adding all of that up, that's another 9-point-something%.
It's 9.3%. And I'll just give you a quick example. So Silchester, as an example.
No, I get it.
They
I
have,
get
yeah,
your
on a
point.
look-through basis, you have
I get your point.
20% in this area.
What I'm trying to communicate is that I think an option like this would be as a 5% option or something in that neighborhood would be probably a superior allocation than our real estate or our fixed income portfolios at this point. And we have enough, without changing the allocations, we have enough percentages, as I understand from seeing it, to allocate 5% to this and take it out from those categories.
Take it out of fixed income or real estate.
Yeah, somewhere in there, like 2-3%. We can see the details of exactly how to execute it, but and see where we have more allocation within our limitations of minimum and maximum, where we can take it out of.
You could do that. I'll just start with, we would not be a proponent of a dedicated allocation to a natural resource, liquid natural resource fund or commodity fund. I think, you're talking about the Bank of America. I'm assuming you're talking about your 401k plan at Bank of America. It's not a defined benefit pension plan.
Correct.
You have the ability to make a decision to go into something and very easily come out of something.
Correct.
With a government pension fund like this, it's not it. It's like moving a battleship. It's much harder, as you've seen, to get in and out of things. So historically, most, if not all, government pension funds work with a strategic allocation. The board makes a strategic allocation, makes decisions what asset classes to allocate to. Tactically, underlying security decisions are left to managers. And we understand that with that nature, we don't disagree with you on where your valuations are today in equities and that the US has a lot of debt. That's why you have non-US equity, significant amount that will help for dollar debasement, emerging market equity, as well as this natural resource exposure. Adding a dedicated single natural resource strategy, while it may be beneficial in a short period of time, making that decision when to get out of that is much more challenging. And I've seen it.
Okay, so let me address a couple of things. With all due respect, right on this table, you all were also against increasing the international exposure that I kind of fought for about a year ago. Number two, this is not an in and out fund. I don't know why you're viewing it as that. I would think you can easily stay in here for 10 years. What's going to change? Is the debasement going to change? I mean, this is not a 6-month allocation. I mean, this is what's going to happen to the bond portfolio over 10 years versus something like this? What are your bonds going to do, especially in a stagflation environment if we hit it, or inflationary environment if we hit it? What are they going to do? Nothing at best. Nothing at best. So you got an asset, nothing at best.
Let's get, just to maybe broaden the conversation, on page 22, if I could take you there. In terms of the long-term holdability, something like a dedicated allocation. In current form, you have active managers that are already going into and out of these. And again, going back to, there is no incremental cost for having exposure that you already have. But on page 22, the long-term holdability, these are the 3 strategies relative to equities and relative to real estate. So take a look. This is a 15-year period. PIMCO, VanEck, Principal, they've been allocating in these areas in the environment. And equities have done 3x. Global equity, public equities have done 3x this real assets category, if you will. And real estate specifically, which has had its own challenges, is 2x above that. So holding it for 15-year period when it underperformed equity, broader equities by 600 basis points would be a tough hold. At the same level of volatility as equities.
So we don't allocate based on rear view mirror. We allocate hopefully depending on what the environment is and what we expect for the next 10 years.
Agreed, which
Okay,
is,
so if we allocate based on last 10 years, I mean, it doesn't make any sense. Then what are we doing here? I mean, let an AI program just mine that out from last 10 years data and allocate.
no, it's informed, I mean, decisions are informed by rearview mirror, but also looking forward, which is why we feel confident.
We have defined an environment. I'm sorry, I disagree. We have defined an environment that may not have been true, although it was a little bit, of the overvaluation right now and the money printing that 20 years ago, we were at what, 1.5 trillion debt? Okay, we are sitting at 40 trillion debt. How can we compare last 2 decades to now? I don't even understand.
Well, but
And plus commodity cycles go through a long cycle. They're typically not a 2-year cycle or a 3-year cycle. They're typically longer cycles. And number 3, what is our allocation to fixed income right?
So
20%.
No, total portfolio allocation to fixed income.
20.5%.
Okay. You tell me, in your view, what do you expect of that 20% if it was your account? I understand this is a public pension
our
plan.
capital market assumption is around 5.5.
5.5 on the
With
bond
a standard
portfolio.
deviation of 5.
A little less than that.
Right. Whereas commodities or even a hard asset strategy like this, our capital market assumption, commodity capital market assumption is
The vol's 20 plus, and the return is mid-single digits.
about the same. So from a strategic standpoint, from a modeling standpoint, it just doesn't make sense.
So it doesn't make sense that both have the same kind of return projections by your company.
By most, if you look at,
I mean,
I don't
I can quote others that would not agree with your forecast, but that's not the point. You are the consultants here. If they're both the same and 20% is in a bucket, and this thing has a projection of producing a similar return, why would we not diversify and put 3 or 4 or 5% in it of that 20%?
with 4 times the volatility.
With the possibility of providing a real return also, which the bond portfolio will never do.
Which we believe you're getting that exposure. We're not going to agree on this.
I mean,
We're bringing information that you asked for. We're also telling you what our opinion is, that we're not proponents of it. I understand that you disagree with that. And if the board as a whole chooses to do that, we're happy, we brought you information and we're happy to go back and bring. a
Yeah, and I
different
don't disagree,
mutual
and I
fund,
don't agree
retail
with
mutual
you.
fund.
Just like when you argued why I don't increase the international exposure a year ago, I didn't agree with you and I don't agree with you today, unfortunately. You got 20% sitting in an asset class that's also likely not to produce that 5%. And you got a possibility of another class where you need more real estate or real asset exposure because you have some direct, I understand that. But that sector still remains under-allocated in the US right now. It is under-allocated.
Yes, director.
Real assets, precious metals, real assets, all this. I mean, yeah, so energy has gotten more of a interest recently because of all the data centers and whatever else. But it's in the US, if you look at it, it's under-allocated versus where the demand's coming from. The demand's coming more internationally, but the allocation's happening not in the US. And so this mindset continues of under-allocation. So I don't know where we go from here.
so
There are times.
from our perspective,
Excuse me, Greg. There are times when it's prudent to overweight certain asset classes. because of the environmental trend, may overweight domestic versus US, domestic versus international, international versus domestic. You may overweight large cap versus small, or mid cap versus emerging markets. There are times when you overweight something beyond where our usual asset allocation strategy is.
Sure.
Now, the question is, does the current environment demand a very heavy weight to those factors that we were talking about before? And are we already getting the weight that would be reasonably ideal with the portfolio that we have?
And I would agree with everything you just said, and that's why we like the portfolio today as much as we do. And the
The way it's
implementation,
structured right
from a
now.
forward-looking perspective, to Sharik's point, it's not just a rear view argument. It's what you own today, in that you're right. We want managers to actively allocate into and out of these areas, everything that we've been talking about, gold and precious metals, energy and things like that. You have active managers in the portfolio, the Silchesters of the world, your entire portfolio. They have the ability to go into gold miners, get out of copper miners, go into aluminum, get out of aluminum. They have that ability today, and they're doing it. About 9% of the portfolio on a look-through basis is in those things. And that's that tactical aspect of it. The reason why that should work is, think about the BlackRock issue. If you did want to tactically move those things, by the time it got implemented, maybe the ship has already sailed. Embedded in your portfolio today, they can do that on a day-to-day basis,
Yes.
and they are, which is why there's 9% of the portfolio today in these things that we're talking about. And there is no incremental cost, whether it's 17 or 95. You already have those things. So we think the diversification of the portfolio has been such a benefit, but sometimes diversification doesn't help you. Relative to ACWI, not your targets, but relative to the global public equity benchmark, you are and have been overweight international. That has hurt relative to global, because US has been the only game in town until last year, because the currency has weakened. So your portfolio did benefit from that. My point is that sometimes diversification goes against you, meaning
Sure.
if S&P 500 is the only game in town, that will hurt you. But this is for the next 30, 40, 50 years. And we think the durability of this portfolio and allowing the managers the ability to go into and out of real assets is the best way to implement for the plan.
So
The best way to meet the challenges that we've already laid out.
At
So
all of
we
the
have to
issues that
manage
Sharik is
to
talking about,
respond to those challenges is what I hear you.
as opposed to our structure where it would take a long time to implement and then tactically allocate.
Or as opposed to a purely passive approach.
That's right.
On all of our assets, then you never can take advantage, or
Right.
you're always either are the beneficiary or the victim of whatever the overall market does, but you don't take advantage of where you see there to be above average, so to speak, opportunities.
And the last bow on that is the valuations. You both were talking about everything's being expensive. That's another benefit to active management. They're not going out. You have value managers. They're going out and trying to buy cheap things. They're relatively inexpensive. So always trying to find, price to sales might be high, price to book, price, whatever price ratio that you want to look at. They're going out and trying to buy the cheap things. Well, over the last decade, up until recently, the only thing that's worked is growth. So the Silchesters of the world are saying, we're buying cheap things. It's going to work at some point. Recent shimmers have suggested value has come back into favor, and Silchester did its role. It outperformed. So you have so many components in the portfolio that should work in different times. It's just sometimes it's not work. They're all not working in sync, but the total portfolio should. That's the point of the diversification.
So let me answer a couple of things I think that were brought up. One of the things that was brought up is 10 years ago, we were in international. I wasn't here 10 years ago, so I don't know why you were overweight 10 years ago on international. That was a decision I was not part of, that probably you can address why you allocated 10 years ago. I only suggested that when I joined because of dollar devaluation, I can only go with that. Number two, if the market is overvalued, what you're saying about managers going in and out, that doesn't typically happen. They stay to their mandate. They have to stay true to their mandate. So, for example, if the manager who is a very good manager, they are not a stupid manager, they have a very intelligent team, they will not sell a market that is overvalued. The reason they will not sell it is they have to stay true to their mandate that they were hired for that exposure. So people say, why was my manager that stupid that they didn't know the market was overvalued? That's not what they are hired for. So while you're correct that some exposure comes indirectly through that, I have no qualm with that. I'm not arguing that with you, that they have some minors and they'll benefit and all that stuff. What I'm trying to communicate is we have 22% in fixed income right now. Okay. From our mandate, we can go 15 to 30%. We have 10% in real estate. We can go 5 to 15% in real estate. That is the asset class I'm trying to target. I am not saying this is an option to the equity exposure right now. That is overvalued as a solution to that. So let's stay with that. Now the question comes, if we do that, and we're talking about a 5%, so we take 2% out of fixed income or 3%, and we take 2% out of real estate, okay? That gives us the 5% for this allocation, okay? In my opinion, and everybody has an opinion, in my opinion, this has a chance, of course, it can not perform, it can lose 20%, of course, there's no guarantee, but it has a chance with the backdrop of dollar devaluing, debasement, and these assets not being, both the real estate and the fixed income poses have a headwind right now, in my opinion, that can come. So as a result, if we allocate 3% from one of them and 2%, I think that would be a superior solution, in my opinion. And we stay within our allocations.
You're saying reduce real estate further to what? I'm sorry.
Take 2% out of our real estate.
Yeah.
Okay, we are still in real assets, and take 3% out of fixed income.
Okay, I just want to get.
We are able to drop to 15 is our lower.
I just want to get the arithmetic.
And we can do a vote on this. If that's the next step, I say let's do a vote on this and move on.
Do you have anything further to?
No, you can certainly do that within those guidelines. That just,
Well, the guidelines aren't important. We control
the 2% from real estate will probably take a year.
2%.
There's still executes to get out of, your real estate is not in REITs. It's in private real estate where there's executes, and we've got redemptions in today that have been in for almost 2 years. So, and there's still, like I said, there's another.
So let's,
2% out of real estate in theory, and 3% out of fixed income. How do you feel about the fixed income budget?
If that's what the board as a whole wants to do, we're not proponents of that.
No. Okay.
We think that you have,
just want to get the
10, almost 11% allocation currently to real estate, and then the underlying, the challenge really is, in our opinion, make the decision to do this, and then the decision to get out when it's not working. We've seen it before with dedicated commodity strategies. And the last cycle, 2010, 11, we saw a lot of clients going into commodities, adding a 5% allocation to commodities.
Yeah.
Boards turnover, commodities were flat for a year. And then everybody at this table is saying, why the heck are we in commodities? How can we get out of commodities?
Yes.
So from a strategic standpoint, where it is challenging to get in and out of things operationally, it makes it harder to do what Sharik is suggesting.
let me solve that for you. You put 2% for fixed income, which is liquid, into the strategy. It falls 50%. By that time, a year, first of all, it'll take 8 months to just do this if we are lucky. We allocate 2%, and by that time, we look for liquidations on real estate, which you have illiquid funds. This commodity fund will not be an illiquid fund. You can get out of it if you want, but that's not the intention. So let's not say that we'd be in something that we can get out of. That's incorrect. We will be in something that we can get out of if we need to. Number two, the allocation is small. Okay, we are hopefully making 8% or 7% in the last 10 years, even though we've underperformed on the market. If we put 2% in this and we lose 50%, or we lose, has a 40% correction, it will give us an opportunity to add another percent to it. And that 40% will be 40 bips of our return. And that's a crash. Okay, and if that happens, your stock portfolio here is going to see a similar correction if that's happened. And that will be a significant hit of 10-15%. You will not be worried about the 40 bips on this thing. You'll be worried about the 15 or 20% you've lost on the equity side. So let's keep this within what is real. Okay, and I appreciate that this is a sector that can provide more volatility. But I can also appreciate the fact that we are in real estate and bonds that's not providing us anything, or possibly anything going forward. So that's what my struggle is. And I don't think I'm looking for, hey, let's put 20% into this. It's a very small allocation.
You're suggesting, if I understand it, 5%, 2% will come from fixed income, 3% from real estate.
Yeah,
Is
but
that what you're suggesting?
right. I mean, long term, this will take about 1.5 years to execute.
Yeah, and I understand that.
Yeah.
Painfully, I understand that.
Yeah.
That's what you're suggesting to
Yeah.
be specific. Is
Yeah.
that correct?
Yeah.
All right, if other members of the board, would you like to ask any questions? You've been very attentive. Pepe?
I initially wrote down when Sheree said it, and so I may have captured it incorrectly, 2% out of real estate
Yes.
and 3% out of fixed income.
Is that what you're suggesting?
Yes.
2 and 3, not
Yes.
3 and 2. I said
That's,
3
I
and 2.
just want to
Two and
clarify
three.
what we're.
Two out of real estate and 3 out of fixed income. But I mean, that can be tweaked. It was just an example that you'd
Well,
stated.
that's right.
If you have a
That's
feeling,
suggested.
some of it.
All right. Any other, Pepe, do you have any other?
Well, but Jason, what you're saying is, given the way our real estate investment is structured, we're not gonna be able to get money out of that
It's not liquid.
for a couple of years. I mean, I know we have redemptions in right now that we're waiting on
Correct.
to try to reduce it.
Yeah, it's not immediate. So the XEQs are, they're narrowing, they're smaller. Because now there's more, some funds even have entry queues now to
Yeah.
get into.
But the fixed income is liquid.
The fixed income is liquid.
So you said 2 and 3 is what you recommended. Is that correct, Sheree?
Yeah.
2 and 3, is that what you're saying?
Yeah, somewhere there. I
About
mean,
that.
that can be negotiated. I mean, just an example.
About that. Well, the 2% it's going to take a long time. 3% can be implemented right away. So do you want to make a motion?
I do.
Wait, can I back up and ask?
Well, excuse me, before that,
Okay,
Pepe, you have something else you'd like to
I just
add?
wanted to ask another question, which is in terms of fixed income, is that, and I'm looking at it, primarily bond funds?
Yes.
Okay.
Yeah. This is I can call it the opportunistic ballast of your portfolio when things go poorly. If everything that we talked about, and we've been talking about for the last hour, go wrong, right? Debasement doesn't happen. Equity markets sell off. This is the portion of the portfolio that is meant to protect you in a market sell-off. You would be taking from that and adding to something with more volatility.
Taking from the.
Taking from the fixed income. The pure intention of fixed income for any plan that's designed for 30 years plus. That's the ballast of your portfolio. Equity markets can do what they want to do, right? And it's part of the strategic allocation for not just this committee, but when the next committee comes in and the bodies change, hopefully we're the constant that says, well, why did you take from fixed income and go into something that's more volatile?
In a sticky inflationary environment or in a rising inflationary environment, that fixed income, the value of that fixed income is going to go down.
Yes, but they're also, but
I mean, the fixed income, I
the
watch it in my inventory.
but you also have.
That depends on how
How
fast
active
the,
how
how
much
fast
they
the
turn it
manager.
over.
So if you're in fixed income, so So Pioneer, the multi-sector strategy that you're in, they're in all kinds of things, one of which is bank loans, which automatically reset with inflation, right? So it's not just tips, it's bank loans, it's other things. So they are trying to protect, but their overarching goal is to be the ballast of the portfolio. When things go bad in the equity markets, that's the blocking and tackling of high level diversifications, equity and fixed income. And then you add other things to it to kind of be uncorrelated to those two things.
Is anyone we have in private credit?
No,
In front of what? I'm sorry.
Private.
private credit, no.
Good, just want to check
No.
on that.
So,
All right, Paul, Aaron, any questions or comments you'd like to?
I hear what they're saying, but I also don't think that 3% is a irrational or foolhardy move.
So, I mean, if you,
Sure, let's give Aaron opportunity.
I'll have some questions.
sorry, I was just going to address what already happened. And if risk is a concern, first of all, let's define this for people who are not comfortable in this area. Where is the money going? So according to on page 21, on the last choice that has been provided, Venek Global, which I'm not sure of yet, but let's go down this road for a second. 28% of that money is in oil and gas, energy. Okay. So yes, we have some indirect exposure to energy companies, I'm sure, but let's talk about this allocation by itself. With the energy demand right now coming from data centers and stuff, this is not about to change in the near future. It's not about to change. Would we agree on that?
Yes, but they're
No, just
getting their
let's-
oil and gas exposure through ExxonMobil. It's not.
I
the
understand.
underlying
I'm just trying to decipher what the risk here is.
Okay,
Oil and gas, we are both comfortable, as we say, that most probably nobody can guarantee this, that demand will exist, okay, in that sector. Gold and precious metals, while we have some miners, we do not have gold and precious metal exposure to
Directly.
the metal itself, correct?
agreed, but neither do they. It's stocks, it's miners.
They will not buy ETFs that are gold.
These are,
When they're not
they're
saying
implementing
miners.
this through stocks.
I'm not so sure. You may want to look at the portfolio,
Oh,
but they can buy
I have-
GLD, they can buy GLD, they can buy PPLT, they can buy SLV. These are all
Craig's
ETFs.
in
They're
charge.
getting it through Freeport McMoran, which is 3% of the portfolio.
Okay, then maybe we say that this is the wrong choice. We can buy two ETFs, which are energy and GDX, keep our energies down, we get the exposure directly to metals and create it ourselves. We buy 3 ETFs. We
Who's
can
gonna buy
buy,
the ETFs?
sorry,
Who's gonna buy the ETFs?
we are going to allocate 1% and you're going to execute on it.
We don't execute. We're a non-discretionary investment consultant. We have
No, we'll hold that. So I mean, when you say who will do that, what do you mean? I mean, this is an ETF, just like our other ETFs. We buy the ETF.
It is yet to be determined by our general counsel's office whether or
Sure.
not we can actually buy
You'd
ETFs.
have to have somebody on staff purchase the ETF through your custodian. There's no contract, there's no agreement, the ETF is a security. It's an operational issue. It's not.
I thought we had that sorted out.
It's not sorted out, to my satisfaction.
We need to sort that out in this environment and in this day and age.
Cato was working on that.
It's been a long time.
I mean, we are basically at a distance.
It's not sorted out yet. Should have been sorted out. It isn't.
Okay,
So I'm not sure we can buy ETFs in any event. Plus, well, again, we wanted a manager who could move to asset class for asset class, even if he wanted to do this easily, quickly, fully. And buying ETFs would mean we're making that decision. We can make that decision.
and the reason that was done is because recognizing that we are sluggish on our side. So that somebody you can allocate within that sector, would be a better choice. Anyway, I mean, if we say, if we go down the road and you say, oh my God, that's bonds, that's like your safe money and the market's overvalued. And if the market's over, let's take 2% of our equity exposure. I mean, I'm open to all these options that everybody thinks that this is possible. We have currently 68% in US equity, I mean, all equity, sorry, 68%. Our range is 50 to 75. We are on the high end of that range. We are not on the average. The average would put us 25 divided by 2 is about 12 and a half, would put us to 62.5. We are, that math has actually no sense to it in one way. All I'm saying is we are towards the higher end rather than the lower end of that equity exposure. So if all of us decide that, hey, listen, I would rather play this safe right now with overvaluation. Okay, let's take 2% of the equity then. I'm okay with that. I just think we need allocation to this. And if we do have a correction, I say we add 1% or 2%. It's going to take forever to do it anyway. I mean, let's get the fund approved and started. They'll probably get a 1% allocation initially, take and then build to it as we go down this road. That's how you do it anyway. You kind of like average in according to the thing, but we have to have it on as a choice, approved, like the BlackRock. So at least we can say, hey, can we add 2% to BlackRock now? I mean, we can't even do that till it's in the portfolio and approved.
All right.
When we're talking about taking 2% of fixed income, describe to me what fixed income is, or for this matter.
Your bond managers, so IRNM, Pioneer, and Janus Henderson. They invest in fixed income securities, so US treasuries, corporate bonds, mortgage-backed securities or structured products. Pioneer, to a larger extent, will include non-dollar bonds.
Okay.
So not non-US government bonds, bank loans, some.
A non-investment way to think, this is intended to be the safer portion of the portfolio. So something above cash, something,
They're loans where they're getting an interest rate payment back.
and it's, to Pepe's point, it's usually a set. We're gonna give you 4% for your money for whatever duration, whatever time frame it says, 10, 15, 20 years. And they actively manage that.
So I'd like to answer your question. Because I think maybe everybody benefits from this. So there are two ways a company can borrow money. They do equity, which they give you an interest in the company. Okay, the company does well, the stock does well, we benefit. Or they can borrow money like a loan, which is a bond. Okay, so they say, hey, we are issuing 7% bond, which we promise to pay you 7% a year. And we you buy it, let's say personally. But there's one thing to notice here when we say save money. A year goes by and now the company wants to borrow more money and the going rate is 8%. Okay. You're looking to sell your bond and Pepe goes, hell no, I don't want to buy your 7% useless bond. I'm going to go buy a new bond from the same company at 8%. And you're like, well, but I need to sell this. You will have to decrease the price of your bond, right, to make what is called the effective yield the same as the 8%. Does that make sense? Okay. So in other words, rates and prices are inversely related for that reason. You will have to drop the price not to some arbitrary thing. You will have to drop the price to the effective yield comes to the current market rate. Okay. So when we say safe investment, these bond funds are not holding these bonds typically to maturity. They are managing a bond portfolio. Okay. There are things that go with it. There are certain things like duration and stuff that say how the length of the bond averages and how sensitive. So a longer bond, so if you had a 30-year bond, it would be a whole lot more sensitive because you'd have to discount 30 years of value versus a 2-year bond. Does that make sense?
Yes.
Okay. So while we say this is our safe portfolio, yeah, I mean, and it is, it's not wrong. It can suffer.
It's relative.
Yeah, it can suffer volatility.
When rates go up, bond prices come down, but also for long-term investors using active managers, then your yield goes up.
Sure. I just wanted to
For the
break it
long
up
term,
in simple
If
terms.
you had that issues that you're talking about, you would have a short-term haircut, which we saw in 2022 when rates went up by 400 basis points. And now, then the expected return for fixed income is more attractive in 2023, 24 than it was for the entire decade before that. Because rates are now no longer at 1.4%, they're at 4.5 to 5%.
So the thought is to take 2% out of fixed income and put that into different equities.
These are all choices. One thing I'd like to add to that is we recently heard the administration being very adamant about decreasing short-term rates. I'm sure you saw it all over the papers, literally fighting and abusing the Treasury chief to say that he's not reducing the rates. When they reduced the rate last time, the long bonds went up. That was a anomaly. That's not the usual reaction. The reason they went up is they saw that move as an inflationary move because you're reducing the rates when you should be possibly increasing them. My point is, if we do go back to that focus at some point of decreasing short-term rates, our bond portfolio will get hit. The other alternative, there's only one path to lower rates, and that's a recession. Okay. So when you say, well, the other thing can happen, sure it can, but how will it happen? It will happen in a recession. It will not happen without that. So now let's stay with that thought. What will happen to equity prices in a recession? Much more than your bond portfolio going up.
But maybe to your point, the implementation of the real assets that are going into there, while they may be categorized as oil and gas, at the end of the day, it's ExxonMobil, which is a stock. So if we do have a rollover in equity prices, that's where the volatility comes from in strategies like these, the real assets, is because at the end of the day, they're predominantly invested in stocks.
Here, can I propose something?
Oh, you may.
I would like a,
Yeah.
I would like
want
to
to bring us to a vote momentarily.
yeah,
But Aaron, is there anything further you would like to ask or contribute, or Pepe?
No, I mean, I think the thought is how long is this gonna take? We take 2% out. How long is that gonna take to do that? Just thinking of other things that have taken quite some time. And then what would be the rationale against this from HCG's perspective?
The rationale, again, my mind, you already own. And this would be increasing the cost. It would be increasing the complexity, and it would be net increasing the volatility of the program.
And how does it increase the complexity?
It increases the complexity because we're doing something in the program, right, that is real assets. And while there is a champion today of that, you made the comment about why, I don't know why international was 10 years ago, why you were.
to your comment, that was only
Right,
a
right. But
response.
what I'm getting at is 10 years from now, the bodies in this room are going to change. And they're going to say, why did you take out a fixed income and go into real assets, which were comprised of equities? You know what I mean? So I think that's the complexity of it as well, is like you have a strategic target. This would be changing the strategic target, which would imply, how does this impact the overall risk return profile? You got a number that you got to hit, 7.25, right? How will this impact that? How will this impact the volatility? How do we think about that? So it's just
Yeah, and I would say we have a strategic allocation that has 10% to real estate. And we understand and agree that inflation, not just today, but always is a concern. So from a strategic allocation standpoint, the allocation to real estate is designed to be an inflation hedge. It provides a premium return to fixed income over time with less volatility at the portfolio level than equities. We also understand that non-US equities, non-US fixed income have diversification benefits. If there is a debasement in the dollar, a decline in the dollar, that you get a benefit from that. We've seen it this year. Your equity portfolio, as Craig mentioned, those managers have the ability to allocate to not different asset classes. They're not going to get out of equities and invest in fixed income. but different sectors. So when they believe that there is more value in energy, materials, mining companies, they can allocate there, and you're getting quite a bit there. So we don't disagree with the potential issues and concerns. We think your portfolio is structured strategically to address those things. If the board as a whole believes that you want to double down and have a dedicated strategic allocation of 5% to an individual mutual fund, we're not proponents of it. I don't think it would have a meaningful impact one way or the other. It's not necessarily going to hurt you. I don't know that it's necessarily going to help. 5%.
All right, then let's bring this.
Well, I think that's my last question. Then
I'm sorry.
the 2% goes to who? The 2% goes to one of these equities?
Well, we presented three managers. We're presenting three managers in response to what you asked for. We're not recommending any of them.
Okay. But Sharif, that's.
But if Sharif says that there's a mutual fund, index fund that he likes, we're happy to provide that data to you. We're not going to change our opinion on what we think you should do. I don't think you would want us to do that. It doesn't mean you have, if you choose.
So the fundamental question is, should we adopt a new 5% allocation to be implemented over an extended period of time by definition to a dedicated fund dealing with these types of assets or opportunities? That's a key question. After that, where does it come from? After that, which vehicle? We don't have to decide the vehicle today because they haven't seen the information on, the board hasn't seen the information on the State Street vehicle that you talked about. All right. Can we bring, if you want to bring your.
There are a few things I want to say before the vote, if that's possible, real fast.
Scott, do you have anything further?
No.
All right, please.
So 2, 3 things. We do not have the vehicle defined today. Okay, so we between the choices given there or this, more work needs to be done. We don't have where exactly we're going to pull this. That's going to require a lengthy decision between the board here, which should be done at a future date. However, we can decide on, listen, fundamentally speaking, this makes sense, and we can allocate moving slowly a total target rate of 5%, which may be 2 or 3%. They brought in a higher risk level, but at the same time, they say it's the same stocks we own in our portfolio indirectly. So I don't see how this is being viewed as a higher risk. Well, commodities do have higher volatility.
It's higher
Number
risk than what
2,
you pay.
number 3, we are looking at a very small allocation because there are 2 or 3 things that we are almost certain of over a long-term period. One certainty is that the dollar will debase. How this happens, what it happens, it will happen. Let's talk about another big dynamic that's going on, AI, right? So AI will take jobs. How many jobs they take, we can discuss. How it will happen, we can discuss. But they will take jobs. These are things we know. When consumers get weak, whether they're getting a general universal income check coming to the house when the employment goes up, we can discuss all that. Nobody knows the answer. But the consumer will suffer when AI takes jobs. Okay, so what does that mean for real estate? We already having commercial real estate getting hit. If the real estate market, including the cost going up, is not very conducive to people buying homes and that whole area, right? So multifamilies, whatever, we can discuss that. Point is, we have 2 things that are headwinds to the portfolio that nobody can deny. Okay, everything else is debatable. How exactly? Real assets in that kind of environment should provide us another hedge. They are volatile. Can we take a hit on it? Sure. And I say if we take a 30% hit on it, on a 1% or a 1.5% that we allocate, if that happens, your real estate, your equity portfolio will be hit just as hard, if not harder. Okay, so if you're concerned about, hey, can we lose 30 bips because of this 2% allocation, take it out of the equity then. That we can discuss in the future. But this vote right now is that this allocation to this asset class makes sense or it doesn't sense with the details to be flushed out in the future. That's all it is. Details with fund, where it comes from, and how exactly the allocation is going to happen over a period of 1 to 2 years.
Okay, you've got a hard deadline.
Yes,
Okay, fine.
let's do the
So
vote.
let's ask for a vote. You have to make a motion because you're from.
I make the motion.
Okay, what is the motion specifically?
The motion is to be defined later where the money comes from, but move towards a 5% allocation to a real asset fund to be defined in the future of somewhere in the neighborhood of 5%. To be taken out of, if we want to be conservative, equity, if we want to be more aggressive in terms of non-performing asset classes, probably bonds and real estate. That we will have a separate discussion where it comes from.
So
That's
really,
the motion.
The real motion is really 5%.
Yes,
That's your motion. Would anybody like to second motion?
I'll second it.
Okay. All those in favor of adopting a 5% allocation to, what are we gonna call this? Diversified real assets?
yeah, I mean, it's within real assets. We already have a line there.
5% allocation.
We just don't
diverse-
have-
As opposed to real estate alone, diversified real assets, 5% allocation. Raise your hand. Pepe, you don't prefer not to do it? And you three prefer not to do it? Okay, we're tied.
Okay,
Done. It's just fine. As a practical matter, I wouldn't take it out of fixed income either. Worried about real
the
estate.
problem is we have too many moving parts here in terms of the fund is not defined. I mean, things are not
Yeah.
defined where it's coming from. We'll visit this in the future date.
Right.
It's not done. We
Fine.
need a proper investment vehicle. First of all, hopefully you can bring one that's not a high cost vehicle, which we've been asking for. I don't understand why we are giving these 1% choices. Hopefully you can do better on that side,
Well, at this point, we're not gonna.
whether you agree with it or not.
We're not gonna do anything at all at this point because we're not moving the 5%. So at this point, unless somebody wants to bring this up in the future with new data, that's different. But at this point, we're not,
We're not even going to get funds.
the motion has passed 5%. That's no reason to look at funds.
We don't have to have the motion passed to look at fund choices and define them. I'm sorry. I mean, we don't have to have the motion approved first to look at fund choices. We still need to see fund choices
To do what?
to see
We just decided.
what an executable option is.
No, but we just decided we did not want to execute that option. We
I think it
didn't
was a
want to
tie.
execute.
I think it was a tie, and I think the lack of information is the reason.
Correct. I think you could make this motion down the road.
There you go.
with Maybe a different percentage point and we have some more details.
We have nothing.
We feel more comfortable making a more informed decision.
Fine. All right. That's all do you have any other business you wanted to discuss, Jason?
No.
Okay. You've got a hard deadline. I've got another hard deadline. There were two other subjects I wanted to discuss. We can't, how about the gentleman on the back pay? We can do that quickly, Kim. Where's? Yeah, we can do that quickly. It's a matter of information. Okay, we will go on to, I'd like to have a motion to go into close.
Was there comments first?
Yeah. So, visitor comments, Marion? Joyce?
Yeah.
Okay. Anyone on the participating?
That's an individuals from the public. We have Martha Bohr implemented that says SBC Teams user. I don't know what it does.
I didn't understand what you said. Is anybody anybody listening in, the visitor would like to make a comment? Well, apparently not. All right. Fine. Good. Could I have a motion to close the meeting and move into, closed session.
So move.
All in favor? Unanimous to close.
Aye.
Motion to move into, closed session.
Roll call. Sorry.
Roll call.
Yeah.
That's you.
Aye.
Stephen,
Aye.